Good morning, everybody. It is towards the end of April 2026. Just to timestamp this video, and I'm here today with Robert Winters from Johnston Carmichael, who's going to talk to the engineering manufacturing members in relation to capital allowances around corporation tax. We've had a number of our members who are starting building projects or looking at capital assets and been asking questions around when they need to start considering corporation tax and how to go about doing it. So at this point, can I hand it over to Robert? Tell us a little bit about yourself, and I think you're going to share some slides.
Ailsa, thank you very much for that introduction and for inviting us along today. I'm going to work through the topic of capital allowances today. I'm going to keep it nice and brief, 15 to 20 minutes, to give people a flavour for it. And I'm just going to do that through this presentation, which I'm now going to share with you. Capital allowances, what are they? What do they do? How can they help the engineering and manufacturing sector? Okay, construction and property incentives team at Johnston Carmichael. We're based all over the UK, main one Edinburgh, we're in Inverness, we are in Aberdeen, and we can cover off Newcastle as well because we're not far from there. The incentives team's made up a mix of accountants, surveyors, construction managers, building engineers. I'm the construction manager and building engineering side. I've got over 80 years of experience. A lot of us have worked for the big four, and a lot of us also work for big engineering and project management firms. And as you can see there, our experience is pretty extensive. We do everything across all sectors. We're heavily involved in renewables. We do work in the manufacturing and engineering sector. So we're very sort of technically orientated, and we can cover everything from buildings to machinery that's installed in buildings and all sorts of things like that. So just quickly moving on, what are capital allowances and what we're going to cover? That's the 5 basic things we're going to do today. But I think the key thing for sort of people to understand today is what are they and what do they do? How do they work? What are they going to get? What the benefit from for their business? Okay. So what are they? So essentially they're a form of tax relief on property and assets. As you can see there, it helps reduce your taxpayers' liability for income and corporation tax. So if we think about corporation tax in terms of an engineering business or a manufacturing business, looking at, I always use the example of saying, look, if you think about your salary, you get a tax-free allowance before they start taxing you. Capital allowances is a bit like that. So if we have an engineering business, Ailsa, that maybe spends like say £1 million on a building, a new building, and some equipment that goes inside. When it comes to the year end and they've got a tax bill, they can use some of the costs that they actually incurred on the new building and the equipment to reduce their tax liability. It helps reduce your tax bill more importantly than anything else. It's relevant to all commercial stuff. Unfortunately, you can't claim it on the boiler in your house. That's a big no-no. They don't do residential. And your level of allowances will depend on the type of building. So an empty warehouse, at one end there's just an incoming water main and an electrical supply. I'll have quite low levels of allowances. But if you can imagine a factory that's making roof purlings or making nuts and bolts and everything, there's got to be a lot of allowances in there under the current regime. And it covers a lot of things. It covers your new builds, your extensions, your refurbishments. A big one we see is installation of new equipment into existing buildings, because that can create a lot of palaver, holes in walls, dragging machines in, digging trenches for cables and all sorts of things. So that's quite important. And if we've got any businesses that might be purchasing a new property, then there's allowances available there. Okay. So that's an important one. Is a lot of people forget that it's just about not new stuff that you build. You might actually build something. You might even lease, and if you lease, there can be all sorts of allowances involved in there. And the main piece of legislation is the Capital Allowances Act 2001, which is quite a hefty document. I would say for anybody suffering from insomnia, it's a good read. You'll definitely make it back to sort of sleeping time with this particular document. So how do they work? So if we kind of look at it in terms of, if you can imagine, we call them pools, but if you can imagine pots, there's different pots for different rates, and what you build and whatever you buy will go into a different pot. So if you build a building, it'll have 3 types of allowances. There'll be special rate pool allowances, there'll be main pool allowances, and there'll be structures and buildings allowances. But you might also have some land remediation relief because you might have had to remove some asbestos. So it will all depend on what you spend the money on, Ailsa, more than anything else. For instance, I'm not giving anything away by saying that your electrical system will go into the special rate pool because that's what the legislation stipulates. So certain things go into certain pools. And you'll see in a couple of slides what I'm kind of talking about in terms of what's an integral feature and is defined by law and what's not. So a lot of people sometimes think they can just whip down their fixed asset additions and just go, right, that's 100% and that's AIA and all sorts of things like that. But it's not really, you've really got to have a think about it. The interesting one is things like professional fees. A lot of people don't realise you can claim professional fees because what you do is you spread the cost of the professional fees across all your other pools. So as you can see from that slide there, there's quite a bit. What you've got to be wary of is some people start claiming allowances and then forget they got a grant or a contribution from somebody and you have to take that off. Because then that means they can claim the allowances. So the big one for us is like you've really got to comply with the 3 golden rules. And you can see there is that the claimant must have incurred the expenditure, hence a contribution from somebody won't count. You have had to claim the expenditure of that business. You've got to be a UK taxpayer and you must have the relevant interest in land, and that's an interesting one we see a lot of people falling over with. So that's very much, do you have a lease? Do you have a freehold interest? Do you own the property? Do you lease the property? Have you got some kind of easement or servitude or something giving you a legal right to be in that building or own that land?
What about land remediation relief?
So that's one that a lot of people miss out on. That is what a lot of people miss out on. Some people think it's got a lot to do with Japanese knotweed and remediating land that's been contaminated with diesels and everything. The big one we find is our roofs, asbestos roofs for people. So they might have an existing asbestos roof on their building and they may have to, it might be damaged and they may have to replace it. So land remediation relief is 150% relief if you replace on a like for like basis. But there is a couple of little things sort of tied in there. You mustn't be the polluter. So if you're in a factory and you put the asbestos roof on the thing 40 or 50 years ago, you can't get land remediation relief. You might be able to get 100% revenue deduction, but if you bought the factory with the asbestos sheeting on it and you can clearly show that you're not the polluter, and then you decide to replace the roof, you'll get £1.50 for every pound that you spend. There's our pools that we're talking about. So the special rate pool, the 56% pool, that's a defined list. That was changed back in 2012. They basically turned around and went, right, no, we've got a defined list. These are the things that you can only put into the special rate pool. And then on the other side there is not a defined list. That's your main pool. So that really can be pretty much anything as long as you can prove that it's plant and machinery. And as you can see there, it's, you know, if somebody comes along to us and says, I'm buying a £6 million wood assembly machine from Quebec and Canada to make roof purlins, if it lasts less than 25 years and it's not on the defined list of integral features, then it's a main pool item. And if you're a corporate taxpayer, it's 100% in the first year tax deduction. So as you can see, when we look at, that's why we kind of come from engineering and construction backgrounds, we kind of look at it in terms of what you're doing, what you're building, and what's going into the actual build. But it's these particular pools that are important. And the main reason I'll go on a bit later to talk about is tax leakage. And this is what HMRC are very interested in at the moment. How do they work? There's a basic example of how it works. So you'll need to excuse me. I tried to think of a name of a company. I thought YI Man was limited was a good name for a company from the Northeast. So it's a corporate tax-paying company, and they build a small manufacturing building. It costs about $2 million, and the company manufactures structural timber components for the house building sector. So how does it work? So the construction final account and the fixed asset register is something that we would look at, and it's analysed, and the costs are allocated to the relevant pools. So we'll go through it and go, right, there's the electrics, there's the incoming switchboard, there's some lighting, that sort of thing. That goes into the special rate pool. And then in the main pool, we will maybe go, well, there's some manufacturing equipment and the fire alarm system and the intruder alarm, and there's fixtures and fittings in the offices. That'll go into the main pool. And then £500,000 is the building itself. So that'd be the concrete floor and the frame and all the skin and windows and doors. And that would go into the SBAs, which is a structures and buildings allowances pool. And that comes to about 2 million. And then you see there on year one, the special rate pool is 50%. So your first year of 300 grand, you get £150,000. Your main pool is 100%. So you get your 1.2 million in that year. And 3% of £500,000 is 15 grand. So your total allowances for that year is 1.3 million, 1.365, which is a lot of allowances when you think about it, you know. And what it actually means is, because we look at it in terms of the corporate tax rate. So the cash flow saving over time at 25% would be 340 grand. Because if essentially what would happen there is that at the end of that year one, if YI Man Limited had made profits of £2 million, you would take the 1.365 million off the 2 million, and they would only pay the tax on the balance. It tapers off, as you can see, in year 2, year 3, and year 4. But that's it. That's why we encourage people to do it, really, to really look at this right from the start as they're at the planning stage, and we can chat about that a bit more.
So is there any expenditure that is exempt from claiming capital allowances on?
Yes. So you've got to watch what you can claim capital allowances on. This is where some people kind of, especially in the structures and building side. So things like soft landscaping, if you do any, and sometimes we see people will do that, you know, maybe on their office side, you know, they maybe do like planting around it or lay turf, grassing, that sort of things like that. You're really going to want to watch that. You've got to be careful of stuff where you won't actually get allowances for certain stuff. And just recently we've had, in fact, just in the last week, there's been a case just went through the Supreme Court for professional fees. So there's some professional fees you can't get. They're a bit more wackier and out of the way. They're a lot to do with infrastructure, but you've really got to watch your professional fees. So it just depends. But SBAs is ones that we do ask people to be careful with, because it is a different regime. You've got to sort of calculate it in a different way, but they make it quite clear that, you know, if you're going to put your rhododendrons and your whatever else at the front of your office, you won't be able to claim allowances on that. So that's why it's a key one. Okay, so how can the E&M sector benefit? So interesting one about engineering and manufacturing is that it's not only the business owner, but it's the clients of the business of engineering and manufacturing sector that can claim allowances. So for the business owner, it's really about their premises and their manufacturing machinery. So they build, lease premises, refurbish them, buy in big machines. They can claim the allowances on them. But then if they sell that, what their product is, onto somebody, the person that buys the product can claim allowances on the actual piece of or sort of like product that they're buying. So if we have an engineering and manufacturing, earlier on I mentioned like sort of like wood sort of processing machinery for roof components. You know, if we have the UK manufacturer that constructed them, and I actually work with a client that does that, you know, they can claim the allowances on that. And if they sell it to like somebody and the roof components go to somebody who's got a commercial building and is using them in a commercial building, they can claim SBAs, structures and buildings allowances, on the actual purchase of the roof sort of components. So it benefits. Yeah, it's a benefit. It'll benefit everybody, like, you know. And I think that's what a lot of people don't realise, is they might be making widgets, they might be making, you know, control systems, control equipment. They might be making sort of furniture, kitchen units, things like that. The person that buys them can claim the allowances. Our manufacturing people will claim allowances on the building and the machinery, you know, if they've incurred expenditure in relation to that. So that's a key one for the sector. Anybody that's going to claim their allowances, the big thing is detail, and this is where we're seeing at the moment, because I mentioned tax leakage earlier on. What we're finding is that the revenue are basically looking at people to put things in the wrong pool, so therefore they will get, you know, they'll get challenged. So you've got to put it in the right pool. And that all comes from making sure you've got the right detailed documents, and you're looking at the right valuations, and you've got good information. So I think that's a key one.
Okay.
I'm going to quickly run through some case studies. People can look at this themselves because they'll be able to access the slides. You can see there the numbers that are involved. It is all about, this was a ship build. It was a slipway and a ship cradle, so it was about the contract. So there was a lot of qualifying expenditure here, but it was all about contract information, and that was really important because it gave us the detail, so we could really key down into it and get all the relevant allowances for this particular client. This timber processing facility that I'm talking about, you can see there, there's like a lot of machinery in there. A lot of this came from overseas, and when it came from overseas, the transport costs to get it were included in the capital allowances claim, because it was about the installation of the piece of machinery. So if your machinery comes from Germany, Sweden, or anywhere else, all installation costs are included. Any sort of raft of stuff, transportation costs, and as you can see, there's some quite good levels of allowances there as well. In this particular instance, I had to reinforce the floor, so we claimed that as part of the sort of installation of it. So that could be quite a costly thing.
What about leasing costs?
Leasing costs. Now that's an interesting one. You've got to
or
watch.
Second-hand equipment.
That's the one you've got to watch. So with leasing costs, generally we look at split them out. Something that comes on hire purchase and something that's involved in a finance lease. If you do hire purchase, you're okay with your allowances. On a finance lease, what we've been seeing lately is that the finance company are the ones that claims the allowances, because when you sign the finance lease, what you're basically doing is they claim the allowances and you take ownership of it at the end of the lease payments. But by that time, they've claimed the allowances.
Right.
So you've got to watch that leasing. That's a that's a good question, because that's the one that you've got to watch. Is it going to go down a hire purchase route, or is it going to go down a leasing route? And what was the other one that you said there at the finance leasing?
Second-hand equipment. Yeah, second-hand or refurbished equipment.
Second-hand equipment, that's just a big no-no, because they make it quite clear it has to be new and unused.
Not great for the recycling side of things then.
You better believe it. It's something that we've always said for long enough. It's like what happens, because some of the larger type machines can be recycled. They can be, a lot of people may refurbish them, get them back into working order, and then sell them on.
Yeah.
So agreed. That's one thing you've got to watch, most definitely. Again, it's having a conversation with a capital allowances expert that can really help you out there and decide on what you're going to do more than anything else. So finally, your solar farm, it's pretty straightforward. Again, manufacturers of the panels will kind of look at all the equipment they use to manufacture the panel, but the person that's actually installing it is the one that can, get the big allowances. But a solar manufacturing facility, where you actually sort of manufacture the panels, the frames, the cabling, we can, if you are a business that does that, you need to look at your machinery and your building and your manufacturing process for making all this equipment. So that's really quite important. It's a very, very important one. So summary. So the capital allowances regime is here to help UK businesses. You would be astounded at the number of people that don't claim and the amount of money that's sitting in Treasury. The last article I read, which was a few years ago, they reckoned there was £6 billion of unclaimed capital allowances sitting in the Treasury. So everybody really needs to be thinking about it. Its primary function is to provide tax relief. Any business, engineering and manufacturing business, is investing in their business, so they're entitled to these. But that's a key thing that people should be looking at. Think about it at the beginning. You mentioned this right at the start of our chat. Think about it right at the beginning at your investment and appraisal process. If you're saying, right, I'm going to invest in this big bit of plant, come and talk to us. Because it's not just going to be about the plant. If you're going to put it into an existing building, it's all about, is it going to be supported? Do I have to take the side wall off to get it in into the building? Am I going to have to connect it to its existing supply? It's all about that. It's about people or businesses that pay income and corporate tax. Use it to your advantage. You really have to use it to your advantage. It's not just part of your tax compliance process. It's got complicated over the years. I was talking about the case law just in the last week that's come out of the Supreme Court. Over the last 10 years, we have never seen so much cases being referred to the tax tribunals where taxpayers are challenging HMRC about their expenditure. It's really, really important. And it is it's not really a tax process. It's a surveying and engineering construction valuation process with a tax outcome. We work with people's accountants, but we'll produce a report that we hand over to their accountants and work in line with them. So we're not sort of stepping on anybody's toes. What we're looking to do is just to get it, in time for people, just to make sure that, it's timely and it's low risk as possible.
Okay.
Thanks for that. I really appreciate your time, and anybody else, there's the contact details if you want to chat about anything. Is there any other questions from yourself, Ailsa?
I don't think so. I think that was pretty comprehensive. You've covered everything I think that we get asked at the Engineering Manufacturing Network. So thank you very much for that, and to Johnston Carmichael for offering your services as well. That's it's been really, really helpful.
Okay, thank you very much, and have a good day. Cheers now. Bye.
Thanks.